Good afternoon. Welcome, Friday afternoon, 2nd of October, can you believe? It's been a crazy ride up until now, and I can't believe it. Like the last 3 months of the year is ahead. I sent out an email earlier today asking how you're doing and if everything is okay, if you're still energized and focused and motivated to make the best of the last part of this year. And so, yeah, I don't know. How are you? I'm good. I'm ready. So whatever lies ahead, I'm ready for that. Some of the things I know what's lying ahead and some of them I don't. So we'll take it in our stride and see how it goes. So good afternoon. Welcome to the live show. I want to talk a little bit about tax this afternoon, not about how tax works and all of that, but really about the opportunities that are lurking, in tax. And it is tax season at the moment here in South Africa. So really an opportunity to get access to the latest information, up-to-date information, and just open up new reasons to contact your client and have conversations with them. I'm not going to go through all of them. There's really about 9 or more opportunities that I've identified over time. But I'm just going to focus on 4 this afternoon and share that with you. And then I also want to show you the tool that I've designed that's been going for about 4 years now that actually makes this so much easier for you. But I will show that right at the end. Just very quickly, I'm not even going to do a demo. I just want to show you what it does and what it creates at the end of the day. So let me say good afternoon. Sorry, I'm looking down a little bit because my computer is down here and I'm sharing my screen. I'm going to show you a presentation in a second. So thank you for saying hi. We've got Kobus Klein first in. Good afternoon, Kobus. Nice to have you back. Or to have you with us once more. I don't know if you are back. I know you've been celebrating your anniversary with your wife. So well done on 20 years. And Adrian Jordan, goeiemiddag. Good afternoon. Rezan, good afternoon. We've got Flora, good afternoon. Happy Friday. Yes, fantastic. Carol, thank you. I will respond to your email. You were the first to respond. So I will definitely get back to you. Denise, good afternoon. I hope you're all well. So thank you very much for joining us this afternoon. And let's see what else we can sort of talk about. I've also got Malcolm and Shahida. Yes, die Kaap is weer Hollands vandag. We've got a lot of people from Cape Town. Stephen Nell, good afternoon. Welcome. Nice to have you with us. So let me have a quick look here. So just before I sort of just share a couple of things with you quickly before we get started is that there's quite a few things brewing in my head at the moment. Some interesting things that I want to do around the show and a couple of other things that's also brewing in my mind. So just, look out. There's some interesting things coming. There's some things that we want to do and that I want to really get into and some exciting things I want to offer in terms of the show specifically. So really looking forward to that. And on that note, next week, Tuesday, with the show, I'm going to have Leilani Bezuidenhout and David Kopp on the show. And we're going to talk about, there was an article that was published I think it was in September, could even have been end of August, but where people were talking about what is a broker and an advisor and what we call ourselves and, whether you're tied or independent and all that stuff. And I'm going to have the two of them on the show to really talk about it because the Financial Planning Institute actually responded to the author of that article. And we really want to get into that and to see where are we headed? How is the Financial Planning Institute viewing this? How are we viewing it, I think, from our side as well, and to have that conversation. So really excited to have them on the show next week, Tuesday. So 8 a.m. on Tuesday, the 6th of October, they will be with me, and we're going to have that conversation. So really looking forward to that one. Then just quickly, the Speaker and Influencer Program. That is, I just need to take that off. Speaker and Influencer Program. The applications are closing today. So if you are interested in applying, please go ahead and visit the link at the bottom of the screen. So it's just nextgenplanners.co.uk/conference. And you'll get all the information there, the background to this. It's a completely free program. Only 30 advisors and qualifying people from South Africa will actually be able to attend this. There's no charge. It starts in January 2021, runs for 6 months, and then if you want, you've got the opportunity to speak at the virtual conference in July 2021. So really an opportunity to learn how to speak to groups of people, but not only that. I think the most important part is the the fact that you'll be taught how to communicate, how to put together your message, how to create what it is that you want to say and make sure that you connect with an audience. So I think it's an indispensable skill to have, regardless of whether you go and speak on stage at some point. This is really something that each and every single financial planner, advisor needs, and it's a fantastic opportunity to get involved with this. So if you are interested, 15 women, 15 men will be chosen from South Africa. I know we're almost to the 30 limit. I think there's 4 or 5 places still left. So if you want to, especially women, we need more women. I don't think we're there yet with the 15 women. So please, I want to encourage you, go and apply, join us on this journey and make the most of it. And I really look forward to seeing you there if you decide to sort of take us up on this offer. Then obviously just lastly, it's your last chance to register for to book for the Financial Planning Summit. So this is hosted by the Collaborative Exchange, taking place from the 12th until the 14th of October. Please, if you want, it's only 575 Rand. You earn CPD points. 3 days of phenomenal speakers that you can watch in the comfort of your own office or home. So make use of that opportunity as well. To do that, you can just visit the Financial Planning Summit website, which is financialplanning-summit.co.za, and you'll find all the information there and you can book there. So really excited for that one as well. Alrighty then, lastly, the last thing that I sort of want to share with you before I get onto today's session, if I can just find the thing here. You're welcome to scan the code here at the bottom, or at the top, not the bottom, genade, at the top, to connect with me through the VCF Portal, which is powered by Profile Me. So if you want to connect and be updated and always have easy access to the latest episode and upcoming episodes and all the past episodes and featured episodes, and also the new things that are coming, then please go and check it out. You can go there and you can do that. Alternatively, you can also visit this link, just francodutoit.co.za/portal, and that will also take you to that. So if you don't want to scan that with your phone, or you don't have a phone that's got a QR app installed or doesn't do QR automatically, please visit that link. It's just francodutoit.co.za/portal. And it will take you directly there. You can save it on any device, have access to it. It's always up to date. You've got direct access, or you can connect with me directly from there. So that's really going to become the hub for the show going forward. And that's what I'm going to drive everything for the show through, making the communication so much easier. You can join the WhatsApp group if you haven't yet. So there's lots of things that you can do directly from there. So please go check it out. And as I said, just keep your phone over just the camera. It'll make a little square thing and then just say, do you want to visit the site? And then you say yes, and it will show you our Profile Me VCF portal. So so go check that out and connect with me from that point of view. I'm not going to drive my other channels. I'm just going to go through there, because through there you can subscribe to the YouTube channel. You can find me on LinkedIn. You can find me on Instagram. So everything is basically there. All right, so let's see, before I get into everything. Bongi, good afternoon. Siba, nice to see you again. Siba was a guest before, so nice to have you back. Sipo, good afternoon. Kuba says he's driving back, so he can only listen for now, but on my post, yes, not missing one. And then Arun, good afternoon. Alrighty, so let's get into this. Let me bring up the screen. And I want to just quickly talk about just 4 of the opportunities that one can identify using a client's tax assessment. And that is really, like, sort of, in my mind, the holy grail is the ITA 34 is what it's called. So if you're in tax, you'll know what that is, but commonly referred to as just the tax assessment. So there's really 2 documents when it comes to a client's submission of their tax to SARS. So what they do is they would do an IT-12, usually, if you're an individual, and that is your tax return. In other words, that is the form on which you put all your contact information, your tax number, your ID number, your bank details, everything is on there, and then all of your IRP5s, all of the details will be on there, the interest you've earned, your medical aid details. So everything with regards to your tax for the given tax year. That is then submitted, that tax return is submitted to SARS. They then go ahead and assess it, and then once they've looked through the information, which on e-filing happens automatically most of the time, they will issue a final tax assessment. And you'll see that this document is called the Notice of Assessment, but the number that we refer to is the IT34 or ITA 34. This is where you'll find everything you want to know about a client's tax position. And why I love this document so much is that there's so much that we can do with this without knowing the assets and liabilities, without knowing a lot of other things about the client. So this is really an I don't know how to put it, like an amazing place to start when you don't know that much about a client yet, because a client may not tell you about certain investments they have. They may not tell you about certain assets that they hold. But when it comes to SARS, there's nothing that SARS doesn't know. We find it so often in practice where clients, we submit the client's tax return, and then SARS comes back and say, no, we disagree with this because we know about this interest that you earned from that bank, and they will automatically add it. So everything is there. You will know about, like, if there's like, oh, you're earning so much interest, like, where's this coming from? Because it's not with an investment with me. So there's so much information that one gets from a IT34. Obviously, if a client is willing to share that with you. So I always encourage advisors that when you do a fact find or you do obtain information from clients, ask them for their latest tax assessment. So as long as it's not older than a year, so if you look at the 2019 or the 2020 tax year assessment, that would still be fine. But there's a whole host of information that you can find from there, and also different ways in which we sort of can use the information that is on there. So let me just look at the first one quickly, and this is obviously the obvious one, because this is just, there's an opportunity to increase your contributions to your retirement funds. So on the IT34, there will be a section under the deductions that are allowed, where you will see the code 4029, and that code means that this is that's all the retirement deductions. Now, since when was it? Since the 2016 tax year, this is what you'll see. If you look at all the tax assessments, there will be other codes, and it looks a little bit different from this. But from 2016, we had this change where you could also deduct provident fund contributions. And now all of this is put together with new limits, the 27.5% limit and so forth. So it changed a little bit. So if you look at it today, this is sort of what you'll see on the right-hand side there at the top, where the green number 1 is. You'll see there that is the deduction that has been allowed. So that is how much you could deduct. And in this instance, for this particular client, he made a huge lump sum contribution with discretionary money to a retirement fund lump sum. So you'll see that there was a retirement annuity contribution of 3.6 million. And because of the 27.5% limit and doing that calculation, in his instance, he could only deduct 235,000. So even here you can see that there's an amount being carried forward to the next year of 3.4 million, which is obviously the difference. So you can get all of that information right there. That first line for next to 4029, that's your total contributions, whether it was to a pension fund, provident fund, or a retirement annuity fund. It will show up there. Obviously, any money that was paid to a preservation fund wouldn't show up there, because that's not done with discretionary money, so it wouldn't show. Then there's also a breakdown. You'll see that you can see how much was paid to pension fund. Sometimes people also belong to a provident fund as well, if the employer offers both. So then that can also show there. And then your retirement annuity fund contributions are also shown separately. So it's awesome to see that if there is no retirement annuity fund contribution deductions, that this person doesn't have a retirement annuity. So again, this is information that you can pick up from here without doing an astute or anything like that. So I think that is really, really good. And then at the bottom, you can see the calculations shown for the different limits. So the 27.5 and the 350 and the taxable income and all of that. I'm not going to go into that in detail. This particular sort of discussion is also available as a webinar on Circulus Online, where you can have a look at the full sort of webinar, and I go through everything in detail of how all of this is calculated as well. But for this afternoon, I don't want to get technical. I just want to show that there you can see that somebody that there are contributions being made to a retirement fund, And in fact, here you can see there's an amount being carried forward, meaning that they're already deducting their maximum amount. But otherwise, you would be able to sort of determine that there's still scope to increase those contributions to meet the maximum allowable deduction if one would, in fact, want that. There are a few rules around this that I'll share with you at the end that I do believe that one first needs to consider before just looking at, I want to save tax, so let me pay money to a retirement annuity. But I will get to that. The second sort of way that I use tax, and this doesn't necessarily come from a tax assessment or the IT34. This is more considering tax and this is particularly, and I had a discussion with somebody the day before yesterday, or was it yesterday? Could have been yesterday or Wednesday. I had a discussion with someone who said that they use the tool that we've got primarily for people who are retiring or who are in retirement to sort of determine what their tax position will be. And this is a huge opportunity where we can have a look at how do we combine discretionary and compulsory money in such a way, because it's always this thing about how much money should I take as a lump sum? Should I only take my 500,000? Should I take less? Should I take anything? What do we do? And it's sort of to have a look at where is the balance for this particular client in order to minimize their tax, but also actually what you want to do is try and minimize their drawdown rates. And one can actually do that, because if you think about, if I put all your money into a living annuity and you withdraw from that living annuity, then that amount, whatever you're withdrawing, is subject to tax. So it means that I technically need to draw, if I need 10,000 Rand a month, I need to draw more than 10,000 Rand a month so that after tax I've got 10. In other words, my drawdown rate will in fact be higher. So the more money I can take from my discretionary funds that is not subject to tax, the lower I can make my living annuity drawdown. So this is such an important point for when somebody is retiring, to see, like, how can we structure that and how can you put it together? I just want to see quickly, I'm running ahead. I've got the wrong one here. I just saw sorry, this part is about the travel allowance, but I'm going to come back to that. Let me talk about the investment and retirement planning, because that's what I've been talking about now. So let me first finish this part. So it's about that balance between the lump sum that you want to take from your retirement fund, the discretionary drawdowns, and the compulsory drawdown. Because that, sometimes we think that a 0.5% per annum drawdown or fee or whatever doesn't make a difference. It doesn't make a difference in the first 5 years. But when you go 10, 15, 20 years, it makes a massive difference. So that is extremely important that one considers that. So I just did this is actually from a real life client that I did these calculations for someone, and I sort of had a look at it, and it was a 3 million retirement fund. If you take no lump sum, in other words, you take the 3 million Rand, you put it into a living annuity, and you take 7% per annum as a starting point, and I then work out the tax on that. The person got 185,000 as a after-tax amount. Okay, so now we've got a 7% drawdown, which is already way too high, but that is sort of the income that you could look at from that perspective. So at least to have a baseline and to see, well, can I reduce the 7% but still get 185,000? So that is sort of the goal with this. So then I looked at, well, if I take a 700,000 Rand lump sum, and I then invest the 700,000 and take some money from there, and then the rest from the living annuity, taking no other money into account, I can get 185,000, but my drawdown reduces to 6.74%. And this includes the tax that I would pay on the 700,000. So this is always the thing where we're very quick to advise clients to say, well, only take your 500,000, which is tax-free. But on 700,000, your effective tax rate, I think, is something like 5.36% or 5.32%, somewhere around there. So to pay 5% tax, I think it's 18,000 Rand on 700,000. I mean, that is maybe still worth it. And if I look at this, if it's reducing my drawdown by 0.3% per annum, it may very well be worth it. So that is sort of where you take that. Then I said, well, what if we then take a 900,000 Rand lump sum? So now there's more tax payable on the lump sum. but we invest the balance, and then obviously whatever is left in the living annuity, we take a drawdown from there. So the approach, by the way, was to say, well, I first look at, how much money I can take from the discretionary, and then how much do I still need to take from the living annuity in order to make the difference up, so that I can sort of get there and that I don't go beyond the 7% drawdown rates as well. So in this case, 6.82%. So you can see now the drawdown rate is starting to climb again. And the reason for that is that the 900,000, there's more tax on it. So there's less money being invested after I pay tax on that lump sum. So, so maybe the sweet spot in this particular instance may be around the 700, maybe 800, one would have to play around with it and see. But this is an important point sort of to make there, because if we really look at it and we really do effective planning, we can reduce that alone. So instead of telling the client, listen, your drawdown rate is too high, so you need to reduce what it is that you want to take. So you've got to, in other words, downscale your lifestyle or your needs or whatever. In that case, there's other ways maybe that we can go about it, simply by being tax efficient and by looking at discretionary and compulsory money from that point. All right, so now I'm going to go back to the travel allowance thing. Sorry, so the second opportunity here, and there's no money really in this initially, but I don't know if you ever get this. I know that people are asking financial advisors that got a new job, or there's an opportunity to restructure their remuneration packages and what should they do and what shouldn't they do. But if one looks at what it is that they're earning, often you can see from the tax assessment where there are opportunities. And often particularly where people are receiving travel allowances, there's always these two sort of sides to it. There's the person that don't keep a logbook. And luckily things have changed now. If they reimburse you per kilometer, then, that is not taxable, so that is fine. But as soon as somebody receives a fixed travel allowance, and it's the same every month, then they need to keep a logbook, because that is then taxable. So often you'll find that clients don't keep logbooks, so then they have to pay in tax because they can't prove their claim. Or on the other hand, what you also get on the other extreme is where they are in fact traveling and they could have claimed more than what they received as a travel allowance. So there's a little bit of inefficiency there. And I'm going to give you an example to sort of illustrate that. So assuming the client consistently travels with about 30,000 kilometers in total every tax year, and about 20,000 of that is business, so you can say 2/3 is business. Then if I look at it, if you receive 5,000 Rand a month, and I go and work on these kilometers, I look at the car that the client has got, and we use the deemed cost table for travel allowances, then we may find that, actually the claim that he could have claimed using these kilometers with that car is 100,900. However, he only received 60,000 Rand for the year. So there's that difference of 3,408 Rand. So he could actually decrease his salary and increase his travel allowance, provided that the travel is more or less consistent. And obviously, during this time, nobody's traveling now. But during normal, ordinary times, if somebody travels and it's fairly predictable, it's fairly consistent, it is very safe to sort of reduce their salary and then increase the travel allowance. So it's not making any difference to their total remuneration package. However, as I'll show you now in a second, it makes a big difference in terms of their tax payable. So if we then do a new calculation on this, then if he implements this change, he's going to save 16,000, almost 800 Rand in tax. That's more than 1,000, I don't know, what is that, 1,300 or something a month that he saves. So, that's money that can go towards doing all sorts of stuff, if you really think about it. So he could pay off debt or put it towards retirement or take out more risk cover. So there is an opportunity here to sort of, turn this into an opportunity for you. But this is one of those value adds where this can really go a long way to help clients be more tax efficient. And there's also this misconception, I also want to put that out there, that if you give any kind of tax advice that you need to be a registered tax practitioner, it is not true. It is only when you charge for that advice or when you prepare tax returns and submit tax returns for clients for a fee that you must be registered. When you don't charge for it, then you don't have to do it. So you can go about and say, listen, I'm going to look at this for you as a value add, and I'm not going to charge you for this work. So then you don't have to be registered. And this is really about financial planning at the end of the day. It is not about tax advice and getting people's tax returns and things submitted. So so just to put that out there, that's very important. And as a maybe as a caveat, is that the right word? Is that don't go and give advice or tell people to do things or restructure things if you don't have any kind of experience with this. Rather than refer them to someone if you're not comfortable to do it yourself. But if you have the knowledge, you know how these things work, and you can see that there's this is a huge value add that you can offer clients through this. There's obviously a whole host of things that needs to be considered with that as well, because it does influence other stuff a little bit later on. But it's not usually that big of an issue. All right, the fourth one is to determine the client's correct net after-tax income, which can be used to determine the need at death, disability, and even retirement. So what the heck does that mean, Francois? So it means that I can look at a client's tax assessment and I can say, okay, so at least before any other his normal life expenses, normal household expenses, etc., just his net income, his net after-tax income that he receives, I can determine that from his tax assessment. In other words, I can determine what is the disposable income that this client has got. And in fact, because I know there's a pension fund contribution and I can see that there's a medical aid contribution, I can determine his take-home pay as well from there per year, including his bonuses and all of that stuff. And I've got 2 or 3 years worth of assessments. I can also sort of see, well, the bonus is the same every year, the commission is the same every year. So you know that there's some form of consistency, or you will see that it's very up and down and moving all over the place. So, based on that, one can then go and have a look at, well, let's say you pass away. In the event of your death, how much cash is really lost from your dependents? So the amount of cash that would have come into the family household, that will no longer be there. So without me even knowing your budget, without me knowing your needs or anything like that, I can already tell a client from his tax assessment that, you know what, this amount of money will be lost to your wife and your kids. If you really want to replace that, so in this client's case, 443,000 per year, cash after tax and everything is lost. And there's certain things that are included in certain events and certain things that are excluded. But basically, let's just say that that's the amount. So if you know that, it's very easy to go and calculate and tell somebody, listen, if you want to replace that 440,000 for 5 years, you'll need 2 million rand. To do it for 10 years, you're going to need 4 million in this instance. So those are calculations that can happen based on these. And that's a very good starting point. And the real question here is just to ask, you know what, do you have this much life cover? Or do you feel that your existing life cover is sufficient to sort of provide for this? So that is, I think, important at the end of the day. And you can do the same for disability, and you can do the same for retirement using the same basis. For the same client, this amount would typically be different about the amount of money that's being lost because, for instance, if you die, you no longer need to make provision for retirement for yourself. However, if you become disabled, you still need to make provision for yourself for retirement. So in that case, you may lose more than what you would do on death. And then the same thing when it gets to retirement, then you no longer need any of the benefits. You no longer need anything. You're supposed to be okay. So that amount would also be sort of different. A further question that obviously could be asked is then also as part of this is just to say, you know what about your debts? What about your estate, the fees to wind up your estate? Do you have a will in place? All that kind of conversations can then lead on from here. Now, I don't know about you, but if you speak to any sort of kind of client and you mention the word tax, if they don't run away, it's definitely something that they sit up and listen to. So if we come with something different to speak to clients about that nobody else has been talking to them about, and maybe you haven't been talking to them about this, then there's an opportunity that they would listen to you, and you can sort of come at a new angle or come with new information or, just sort of educate them on more of the things that's going on, because some people are really wasting money in terms of tax simply because they're not being efficient. Now, there's 5 other sort of things that one can also identify from a client's tax assessment, but I'm not going to go there this afternoon. You're welcome to go check that out on Circulus Online. The site will be back on Monday. We have moved hosting. It's now brilliant. It's running smoothly. It's quick. Because we've really grown tremendously on Circulus, so yeah, we needed to beef up the hosting, which we've done. There's the last few things being put in place this weekend. So on Monday, we'll be back with that. So you can go check it out. If you've got a valid Ignite membership, then you'll have access to that in any event. So you can go check it out. So just before I sort of show you the tool that I've got, the opportunities here, there are some rules that we need to follow when it comes to tax. And for me, I've got this golden rule. It's my golden rule. It's something that I came up with to sort of, because I see it all the time in our tax practice where clients are saying, you know what, I paid off my bond. Now I need to pay tax on the rental income profit that I'm making. Should I increase my bond so that there's interest that we can deduct and I don't pay tax? You know, as soon as your main goal or your primary goal becomes not to pay tax or to pay less tax, then one goes down a route where there are definitely solutions out there. For instance, a retirement annuity. But it's not to say that all of your money should be going to a retirement annuity. It's not to say that maybe you don't even need to make additional provision for retirement, although we know in 94% of cases we all need to make additional provision. But hopefully you get my message and my drift here. It's important to consider what it is that we're trying to achieve. And then to say, well, what is the best thing to get us there? And then how can we do this as tax efficiently as possible? Because sometimes, you know, when you get there, tax is simply the cost of achieving your goal. And there's no way, if you drive on the highway from here to Cape Town, you're going to have to pay toll fees. There's no way. Yes, you can take all the back routes and all the things. It's going to take you twice as long to get there, a few tires and a rim on the way there, because you didn't want to drive on the highway and you were not willing to pay the toll fees. So you know, it's not always the best to go that route. But what you just want to do is just make sure whatever strategies and things you put in place, it is as tax efficient as it possibly could be. So that's important. There's always another story that I also tell about a trust, which I'm not going to tell you today, but there's many of these examples where clients, they want to achieve one thing, but they don't want to pay the cost to achieve it. And those things, they don't go separate. It's nothing. There's no way we can achieve the things we want to achieve in life by not paying money or tax or anything to that effect. It's just that we've got to make sure that we don't pay unnecessary fees and unnecessary taxes because that's wastage then at the end of the day. All right, so let me quickly show you sort of the tax tool. Let me just see where it is. Hopefully you can see that. It looks like you can see that. So this is built in Excel. We're busy building this into a proper online web application as well. So hopefully in 2021, first quarter 2021, we're going to launch it. But it's way down, making good progress on that. But at the moment, the version still works in Excel, so it doesn't work on a Mac, unfortunately. If you've got a Mac, it won't work. But from this point, it just works beautifully. You can see that it's got its own menu, so you can't see that it's Excel really until you sort of start working in these cells. Then you may realize, like, this looks very much like Excel. But anyway, so what we've got here, you'll see these at the top is all the tools that are included. So the personal tax and the tax report, that's the main tool. That's really what it's built around. Then just the retirement fund contributions, if you want to play around, if the client doesn't want to do the maximum, they want to do something in between. Retirement lump sum calculators, so they can do multiple withdrawals, multiple lump sums, etc., etc. CGT on investments, and then calculate transfer duty and transfer costs on property. So all of that is included. I just want to show you quickly the personal tax tool and then the report that is being generated. So the whole idea here is there's sort of two ways. And again, so many advisors tell me, like, I don't use the tool because I'm not a tax practitioner. This tool was written and built, so I get excited about this, was written and built for financial advisors. I designed it around what I needed to do in order to create opportunities from tax for financial planning. That is where this whole thing came from. So I used to do it manually and I just couldn't do it anymore. So I then came up with this tool to do it for me. And it saves you so much time and it generates a professional report. So that is what the tool is about. This is not for tax practitioners, although they can also use it. Accountants can use it. And particularly where you have a financial planner and an accountant working together in partnership, or they're in a strategic partnership or whatever, this tool can work both ways. But this tool looks forward and it looks back. So you can use it to do tax calculations for clients based on their return to say what's going to happen next year or what's going to happen this year. I use this tool a lot of the time when somebody says to me, I've got a client that's going to retire, they're getting this investment income, that annuity, this pension, and we want to know what is the tax position going to be. You put it in here, 2 ticks, boom, it's done. It tells you exactly what the tax is going to be. Because inevitably, I promise you, every single time somebody retires, in that next year, they have to pay in tax. Because they get annuities and pensions and things from different sources. Or, like I've got one client who has invested almost all of the capital into fixed investments. And it's interest. And it's tax. It's tax, 30, 40, 50,000 rand tax every single year. But they don't want to invest it in a different way. They don't want to look at another type of vehicle. And that's it. It is what it is. But at least this allows us to sort of say, this is what you need to prepare for. This is how much money you need to put away for tax, because you're going to pay provisional tax. You're going to do this. You're going to do that. So it's very important from a financial planning point of view to be able to do that, because to put in an assumption for tax, like I think the client is going to pay 18% or 20% or whatever, or seeing, somebody is earning X amount and that's a 36% marginal tax rate, and so we put in 36% in the quote or in whatever tool you're using, it's incorrect, because that's not how tax works. So it makes a big difference. So it allows me to determine how much we should be drawing from investments. It allows us to know how much the client must put away for tax, or even if you put on the application form, this is how much tax they should withhold, because otherwise they look at, and this is what happens inevitably. So the insurance company looks at the income. They think it's the client's only income and they tax it accordingly. They don't know about the other company and the other pension fund that's also coming in. So you can instruct them on an application form to deduct more. And you can't do that without knowing what the client's tax rates are. And this is sort of what this tool will show you. So I'm just going to show you very quickly. At this point, it's very simple to use. So there's codes here that links to the IRP5 or to the IT34. All of this shows on there. Just put in the amounts, all annual amounts. You can do company cars, business income, rental income, all of that stuff. The only information you need from the client is their name, just for personalization, and then their age, their current age at the end of the tax year, and then when do they plan to retire. And then you can change these assumptions, and then just how they married, because that does influence the tax calculations. Anyway, so you put all the information in, the exemptions. Most of the exemptions will be determined by the tool, so you don't need to worry about it. It looks at the age, it looks at the different kinds of investment incomes, so it will automatically calculate whatever needs to be exempt. But there's also a place for you to put in anything else, like a bursary, for example, that's been exempt or anything like that. Then the deductions, you've got the general Section 11A deductions. At this point, we don't detail it. We'll look at that for the online one if you want to put in different sort of things there. But for now, it's just your general deductions. Any other deductions or losses, you can do home office expenses, travel cost if you earn only commission, you didn't get a travel allowance. All of the retirement fund contributions, even rollover contributions, all of that stuff can be included. The capital, we can then do the medical aid, and I'll show you the medical aid is so simple. What did you pay? What did your employer pay will come from the information you already put in. And then any additional information, there's even prompts that will show you like what can be claimed and what not. And then you can put in how many members are there on the medical aid. And that's it. It calculates your 6/8 tax credits for you. Excuse me. And then it goes ahead and it calculates the tax for you, and it will show you the tax payable, your rebates, so whether it's primary, secondary, tertiary rebates, your 6/8 tax credits for the medical aid, and then additional tax credits for the medical expenses that you've had, and then what is payable. And then you can add what has already been paid. It will show you whether you're getting a refund or whether you need to pay in. and it will also show you your annual net disposable income after tax, and then it calculates the effective rates here at the bottom. And this is the important part. Even in your F&A, if you're using a system where they ask you what tax rate do you want to use as part of your F&A, then most people would go with a 39%, because if I look at the client's income, and we see, where is it now? Total gross income is 750. You look at the table, it falls into a 39 or a 41% tax rate. Then that's what we use, and that's wrong. Because this client, after everything, only paid 23, call it 24% tax on their total income. So this is the tax rate that should be used in the F&A, not the 39%. I mean, this causes a huge deficit over 20, 30, 40 years in a financial needs analysis. So extremely important to sort of use the correct rates. Now, this is just putting in the information. It does the calculation. Then you get this tax report. There's a full one and a summary one. The full one, so I can make this a little bit bigger. So this can be fully customized. So it's your logo. It doesn't show any of my information. It'll pull in the client's name here, and then you put in your own information once into the system. It's over here. So you can update your information once, and it will stay there, and you can have this completely white labeled for yourself. It then gives you a summary of the client's tax position, so no details. If you want to if anybody's interested in the details, you can print this screen as well. So you can just PDF it. It prints exactly like it is there. So you can also use that as part of the report. But here's where it gets fun. So then we start explaining, because this, most tools are generating reports that's really put together for the advisor. It really looks like a financial statement, line items with numbers, and it's not really, and then graphs and all sorts of things that you and I understand, but clients don't necessarily understand that. So when I put together this report, I went at it from the client's point of view. What would explain it best to the client? And I'm actually going to overhaul this whole report again now for the online version, but for now we talk plain language. We explain to clients in the way that they would understand. So we're just saying, well, what did you effectively pay in tax? So then we just explain that, for every 1,000 Rand, you paid 238 Rand and 5 cents of tax. So that is a very clear indication for a client. And then the marginal rate, we just explain that your last Rand of taxable income was taxed at 39%. But here's where the opportunity starts coming. So you have your opportunity here. So first off is retirement. As I said, it will show you that according to the current year's information, you can save an additional 16,000 Rand per month, or alternatively 194,000 per annum. So what's nice about this is that you can do a monthly RA for anything in between what they're paying now and increase it up to this amount, or with this amount, not up to, but with this amount. Or as an ad hoc, that for the year they can pay in 194,000 as an ad hoc payment to make use of their full. So, and this is the important thing. This is where so many of the opportunities are lost, because when do we start talking to clients about their ad hoc payments? End of January, early February. They've already spent their bonuses. They've already got kids back to school and did all that kind of stuff. Now is the time, because if you get their IT34 now, you can use that to say, well, if things are fairly the same for next year, then you could in fact look at it from that point and say, well, you know what, this is maybe what you can put away additional. So take some of your bonus, take some of your whatever, and then put that towards. It doesn't have to be the full amount, but it opens up that conversation now so that the planning is done now, and you don't wait until February and now, I wish I knew about this, Like if you want to do something in January and February, you got to start talking about it in October already. So that's very important. But now the tool goes further, because there's many tools out there that can do this and that kind of thing. But now it goes and does an actual tax calculation to say, well, if you do this, you're going to save an additional 73,000 Rand in tax. And then it goes further to say, well, if you now take that additional money that you're saving towards your retirement, it's going to generate an additional 12.2 million Rand in capital, okay, that you can have there. And if you take the 73,000, the tax that you save, and you invest that every year as well, you can have an additional 4.6 million. So that means there's an additional 16 million rand. So these are all future values, they're not present values. 16, and from that 16 million, it's an additional 840,000 income at 4% per annum before tax. So this just gives that clear indication about what this would mean to you. It's not only the tax that you're saving, is what does this mean to you down the line? So that is the big part. Then the second part to it is, now what happens if you pass away? So based on this specific client, you'll remember that he had 750,000 rand in total income. Based on the sort of, I wrote a whole thing at the back that would go look at each person's, the information that goes in there, and it determines on death, the dependents would lose 371,000 after tax. So you need 1.7 to replace it for 5 years, or 5.7 to replace it for 20 years. And then it goes on to ask all the other things from there as well. And you can see it's very easy to read this. It's plain language. It follows a storyline. So very easy for anybody to sort of understand this. When you become disabled, in this case, you can do that. It also talks about income replacement. When you retire, it sort of talks about that. If you want to replace 70% of that income, 85% or 100%. And then some opportunities. So remember I talked about if somebody had a travel allowance and they could have claimed more than what they got. So this is, I put it in like this in the demo. So here you can see that they can increase their travel allowance to this amount and reduce their salary to this amount. And there's the current calculation and the new calculation showing that if they make this change, it's going to save 26,000 rand in tax every year. That's more than 2,000 rand a month that will be saved by implementing this simple change. So that's done. You just put the information in, the system would identify by itself whether it can happen or not. And then some other opportunities. So it looks at, if you earn a lot of interest, maybe there's a more tax efficient way to invest your money. It looks at whether you have tax-free investments or not, and then prompts that. And then also it talks about medical aid. So even if there's no medical aid information in the system, it will just ask, maybe you're a member on your spouse's medical aid. However, we find in practice that a lot of times people are not on the correct medical aid plan. They're either on a too high plan or a too low plan sometimes. But often we find where they work for somebody, they're on this too high plan. They're on a comprehensive plan. Nobody's sick. Nobody needs like chronic medication or anything. Yet they're doing that. And if you ask them why, they would say just in case. It's peace of mind. But they can save so much money that they can put towards their bond by just going one plan down, and they can always then again upgrade. But this just prompts them to have the conversation. It's not to say that they have to make these changes, etc., but it does give them the opportunity, and it also talks about gap cover. Then you can put in your own notes here if you want to add anything there. And then just the important notes, the assumptions that were used, and that this is not a financial needs analysis, it's not advice. This is simply information based on an analysis that was done on your tax return. This can then be, and it's starting to rain, so this can then be exported to a PDF, or you can print it out, whatever you want. There's full online documentation available showing you step by step every single field what needs to go in there. And so that's the tool. So if you want to know more, you can just visit the website. You can also go to, let me just up this here, I think I've got it here. Yes, so if you want a free trial, there's a 15-day free trial. You can get it at francoisdutoit.co.za/tax tool. So you've got to go type that in. You're not going to find the link on my website. So you've got to type in francoisdutoit.co.za/tax tool. It'll take you to the correct website where you can see both the free trial and the version to purchase. So if you purchase it, it's 2,500 rand per tax year. So it doesn't lapse. So once you've bought it, it goes on forever. But every tax year is a new version. And then if you're a first-time customer, 2,500 for the year. And then after that, you get a 40% discount when you renew every year. So at the moment, it's 1,500 rand to renew every year. And that's it. So thank you very much for listening to me. I hope there's been some insightful ideas for you, and that you will open some opportunities in this last part of the year for yourself and your practice. So thank you very much for being here. So I've got one other announcement. So from next week onwards, I'm no longer going to do a Friday show. I'm only going to do Tuesday mornings. And I will be looking at, like, do you prefer a Friday morning or a Tuesday morning? So we're going to be once a week, and we're going to stick to once a week. So the show is not going anywhere. In fact, we're coming up with some very exciting and interesting things that we're going to do on the show and with the show. But I think, now that everybody's back to work, and that to really take 2 hours out of a week to come and listen to me is sometimes a lot to ask, particularly if you look at all of the other things that's going on. So I've decided to go to once a week, and that's where we'll stick. There will be other videos coming out on the channel, 10-minute, 15-minute videos at the most, that will replace the Friday thing. But the live show will be Tuesdays, 8 a.m. for now, and I'll find out from you, the audience, whether you want it on a Friday morning at 8 a.m. or you want it on a Tuesday, and then we will go with that. But thank you very much. I appreciate it. I wish you well. I hope that, it will be a lovely weekend for you and the family. And if you want to, sort of connect with me, send me a message, go to the portal and connect with me from there. I will appreciate it. And thank you very much. I wish you well. And if you've got any questions, let me know. Cheers. Bye-bye.